Gold approaching a record high on demand for an investment haven amid persistent debt concerns in the U.S. and Europe. Greece now facing a restricted default, according to Fitch Ratings, after European leaders agreed yesterday to an additional bailout. U.S. lawmakers still debating on raising the $14.3 trillion debt ceiling before the government runs out of cash on August 2nd. And again, we have gold at $1,601.60 the ounce, up $14.60. The record was $1,610, so we're just $10 away from that an ounce on July 19th. My next guest has not just brought himself to our studio, which we always are so appreciative when someone comes in to do an interview with me on the Hayes Advantage. He's brought beautiful coins, and they are so gorgeous. Michael Haynes is the Chief Executive Officer of the American Precious Metals Exchange. Michael, welcome to the show.
Thank you. It's so nice to see you, and it's good to be here. It's always good to bring education and information to your listeners about this important element of financial planning and portfolio maintenance.
Indeed, and we'll talk about some of the coins you brought along in just a minute. But first, I want to take the big picture. I want to take the picture of, here we have gold at over $1,600 an ounce. I'm looking at some of the main points from a presentation you gave this month. Asset alchemy in the uncertain and volatile 21st century. You're bullish on gold. Why?
Well, actually, it's not a question of being bullish on gold. It's a question of being bullish on asset allocation that would include gold. Of course, no one can predict the future. No one knows if cash is better, stocks are better, bonds are better. But there's seemingly a need now for a fourth asset class. And historically, that asset class has included gold and oil and real estate, all of which have different elements to them. But gold seems to be the asset that has been performing both historically in inflationary periods as well as in periods of economic stress and uncertainty, much as we've had for the decade of the 2000s.
So uncertainty, stress, worries about debt. There are those who say, I just want to toss this out. You say it can't predict the future, but you're very much in touch with this market. I believe, you can see his face, Frank Holm, U.S. Trust, U.S. Lewis Global Investors president, has been talking about gold moving higher for years, and he was pretty good on his calls so far. He has said that gold's going to double in price in the next 5 years.
I assume that that's entirely possible, and I think the question for listeners is not so much day trading the metal, but looking at it from a portfolio balance. And the question is we don't invest for today. We invest for what's going to happen in the future. And if your time frame is 1 year, 2 year, 3 years, whatever it might be, you've got to have a view of what the world's going to look like over that period of time.
Now, one of the things you focus on in this presentation is U.S. debt, U.S. monetary base. You also look at the growth of debt versus the S&P 500 and other measures. What's the point you're making here?
Well, I think if you look at history, sometimes can be prologue. So if we look at the history of the United States, and we just have a chart here from 1970 to current, looking at how much debt we've incurred over that period of time, as well as the monetary base over that time, and that's naturally gone up because the GDP has gone up. But if you then look at debt to GDP over this 40-year period, and you look at the monetary base over this period, monetary base to GDP, we have both representatives of fiscal policy and monetary policy, and we all know that that's the foundations of our economics. But interestingly enough, since 2007, the debt to GDP ratio has gone up 61%. And the monetary to GDP ratio has gone up 185%. That's just since 2007. And we're at levels now in these ratios that for all practical purposes, we have never seen.
But the point is the Federal Reserve intends to work down that balance sheet. They intend to go from this huge peak that sprung up during the financial crisis as they did all these long-term securities purchases, bond purchases. They intend to reduce that. That could take those monetary numbers and change them drastically.
That's true, and I guess they could try to go out and jerk all this. This isn't money that's.
But they made it very clear that they intend to do this.
Well, it's not. This is not the monetary-based numbers that are used here. Does not include the funds that are on deposit at the Federal Reserve. This is funds in the hands of the public and other ways that money's out there being used. Now, there are still ways that they have ways to drain funds, but we also all know that if they drain all these funds out of the economy quickly, that very much could indicate. Another dip, whether we've been in a double dip or triple dip or however many dips.
They've made it pretty clear, I think, that they're going to do this gradually and over time. So, I mean, but is that really the linchpin of your argument for gold?
Not necessarily.
Yeah.
The argument for gold is that there's a hole in the portfolio. If all you have is cash, stocks, and bonds, they have not performed well in periods of high inflation. They have not performed well in periods of high economic stress. Gold has a negative correlation, let's say, to the S&P 500, a pretty significant one. So if you are looking for a balanced portfolio, it's important to have some portion in an asset class that works opposite of the S&P 500.
Michael Haynes is Chief Executive Officer at the American Precious Metals Exchange. Michael, in this piece you put together, your latest July report on gold and what's driving the market broadly, you point out that terrorist acts, and we don't know what this is, right? But this is another factor that people have to assess now when they look at their portfolios and they look at the kind of assets they're holding.
I think you have factors in the 2000s that are totally different than we've ever had before in our investing past. We have terrorism. We have fragile financial systems in spades, seemingly. We have a credit freeze or had one, or maybe it's still going on. Nobody's really sure. We have flash crash. We don't know the reason for it, so obviously that can happen again. And hot money. Money can move in the billions of dollars instantly around the world 24/7. So we have a very uncertain and volatile period now, and that creates a different environment that investors today must recognize because it's different than the past. So you're going to need an investment portfolio and an asset allocation that fits that kind of view. Because as you look forward into the future, it's not what I think or anyone else thinks, what you think as an individual, your view of what's going to happen in the future. These things right here, and we were just chatting about black swan events. I mean, today maybe they're gray swan events. They happen.
Well, that's it. There's and all these things that aren't supposed to happen do. I mean, we had the Arab Spring, a wonderful event for the world, right? But where did that seem to come out of nowhere, right? We didn't see that it was brewing, et cetera. But then Japan's tsunami, earthquake, et cetera. But let's get to a very basic point. If we accept that we need to have gold in our portfolio, and we're considering that, your